Welcome to another episode of the Well Off Podcast. Thank you for joining. Today, I interviewed the man himself, Pierre-Paul Turgeon, the multi-unit investor. As some of you guys might know, he offers different multi-unit investing courses and such. So on this specific episode, we talked about his childhood, growing up in Quebec, working as a CMHC underwriter, his experiences with that and how that led to him buying his own apartment buildings. And he's based out of Edmonton, Alberta. So we discussed that market a little bit. We talk about evaluating these multi-unit assets, not just evaluating them, but the two different ways to finance them. So you can go with either a conventional mortgage or you can go through CMHC insured. So we talk about the pros and cons of both, some of the expenses that you can expect or some of the acquisition expenses, let's say, in terms of buying these properties. So these are just some of the things we covered. There's so many good things in here, I should say, and I think you will appreciate the content. So let us know what you think. Leave a review on iTunes if you can. Make sure to share this with your friends and family, and always happy to connect with you. Go to welloff.ca and book a call if you want to chat. And also, if you're looking for a free report, which we cover the real estate investment strategies, some that might be good for you. There's all sorts of different reports on there that you can download. Go to welloff.ca/report to download it. I hope you'll enjoy. And just one last thing before we get started. I'm working on some 4 to 6 unit projects in St. Catharines and Welland. Lots of opportunities there. If you want to connect on that, if you are unsure about how to invest in small multis like that, reach out to me. I'd be happy to share with you how I can help you. Again, welloff.ca and book a call with me and we'll chat soon. Enjoy the episode. Welcome to the Well Off Podcast, where the goal is to motivate, inspire, and share success principles. I am here with Pierre-Paul Turgeon today. I'm going to say his name the French way. So Pierre-Paul is a multi-unit real estate investor, and he focuses on apartment buildings. I'm sure a lot of you have heard of him. A former CMHC multifamily underwriter, and currently has a portfolio of about 130 doors valued at over $20 million. So the cool thing about Pierre-Paul is that as a CMHC apartment building underwriter, he's been in a position where he's had to analyze hundreds of deals in multiple provinces in Canada. He's probably analyzed more apartment buildings than most landlords in the country. So he's a wealth of knowledge, and I look forward to picking his brain. Pierre-Paul, thank you for joining today.
Thank you, George, for having me.
Yeah, my pleasure. So I like to start off by asking you a bit about your childhood, where you grew up, and one or two things you remember from then.
Oh my gosh, I remember chaos. I'm number 9 of a family of 12 kids, so your typical, typical French-Canadian family. I did not grow up with a portfolio of $20 million worth of buildings. Didn't grow up with a silver spoon in my mouth. But I remember a very loving family, lots of food, great food. My mother was an amazing cook, lots of outdoor activities. That's what I remember. But chaotic because, it's a lot of people around the table, 12 of us. I have 6 sisters and 5 brothers, believe it or not. Wow. So everybody's still alive today. So
awesome. That's great. Where did you grow up? Which part of, I'm assuming in Quebec somewhere?
Yeah, I did in northwestern Quebec, very close to the border with Ontario, a place called Rouyn-Noranda. Rouyn-Noranda, some people might have heard of Noranda Mines. Used to be one of the largest gold mines and we had in Canada some 40, 50 years ago, and copper. So it's a mining town, way up there in the bush. But
okay,
a little community.
Must have been freezing cold out there.
It is. It still is. But yeah. I'm in Alberta now, so it's even worse, I think.
Oh, yeah. Is your family still out there in that part of town? Yeah.
Yeah. Half of them are still back there at home. And some are scattered. I have a couple in siblings in Ontario, some in Montreal, but half of them are still in that small town of, it's about 55,000 people in that town, in that city.
Okay.
Yeah.
That's pretty big, actually. That's like the size of Welland here in Ontario.
Yeah, I know Welland, as you probably know. I know Ontario very well, actually better than Quebec. But Welland is pretty. But yeah, it's a decent size. The only drawback, which is not really a drawback for these people, George, if you want to go to a large city, it is a 7-hour drive through a provincial park. So it's a long way to a large city. Mm-hmm. A very long way to a large city. Yeah.
Yeah.
But, people do it. People will go and watch a concert, go to Montreal, drive to Montreal to watch a concert. And it's
Right.
about the same distance going to Toronto, about 7 hours, but it's going straight to go to Toronto, straight south or southwest a little bit. Montreal is you're driving southeast for 7 hours. Yeah.
Interesting. Yeah, I know this is the first time we kind of formally speak, but I went to a French school in Ontario all my life, pretty much, as when I was French elementary school and French high school. And we would always have to read books on stories about Quebec or novels by French authors from Quebec. So I just remember Kamouraska was one of the ones that we had to read.
Oh, yeah.
And we had to.
Classic.
Yeah, we had to learn about all the culture, and it was interesting to see how people lived at that time in Quebec.
Yep.
Yeah. Okay.
A lot of traditions in Quebec.
Yeah. Yeah. The food's awesome too. I love that part.
Yeah, for sure.
So yeah, let's jump into some of your current work. I mean, you started off as a CMHC underwriter. So
no, actually, not as an underwriter. You mean real estate? I started at CMHC. You may not know this, George, but I want to talk about this a moment because it is, and you said that I think your goal is to inspire people.
Mm-hmm.
I started working for CMHC International. Okay. I don't think that division of CMHC exists anymore, but CMHC was approached, get this is pretty cool. Obviously, when I teach and speak, people focus on the real estate portion of my career at CMHC, but I started working for CMHC. I had just gotten engaged to my wife, and in 96, CMHC was approached by, get this, the World Bank and the International Finance Corporation, which is a subsidiary of the World Bank, to help the Middle East, West Bank and Gaza establish mortgage default insurance. And at that time, beyond that, CMHC was also providing consulting advice, how to set up housing systems that we have in Canada. As you know, our construction systems are very sound and all of that. So I started working for CMHC in the international division. And like I said, at some point, the World Bank approached us to start helping West Bank and Gaza, which is in Palestine, so around Israel and surrounded by Syria, Jordan, and all of that, to help them set up mortgage default insurance. And at that time, I was a project manager. I was liaising with the Canadian Development Agency, CEDA, Canadian International Development Agency. I think has a new name now, but it's our Canadian aid agency. And we were basically, CMHC was providing consulting advice to the Middle East and other countries after that. I ended up working on projects in Romania, Africa, China, pretty cool stuff actually. But I was, as a project manager for these things, I did not have that core expertise in mortgage default insurance, which, just to be clear, sometimes, what CMHC does, CMHC is a mortgage default insurer. So, and I wanted to acquire that knowledge as well, the core expertise of CMHC in mortgage default insurance. So I asked for an assignment out in Alberta. I love the outdoors. I love the mountains. It's a big theme in my life all the time. Probably after this interview, my friend, I'm going to put my hiking boots with my wife and my son and a few friends, and we're going to hit the mountains today. It's a beautiful fall day. But that's sort of my career at CMHC. So in order to do that, I asked for an assignment in Calgary, and I started doing single property underwriting, like principal residence underwriting. And after that, which is very cool, this is also something that gets overlooked in my sort of biography, if you will. I manage CMHC's Prairie office for default management and real estate. Okay, when people default on their mortgages as well as apartment buildings. And I was actually bored because apartment buildings rarely default, and even homeowners in general in Canada, they don't default on their mortgages very often. So I was so bored in that department, I asked to become a multifamily underwriter, which I did for 4 years. And truth be told, I saw people make a lot of money, George. I said, I want to do that when I grow up. So I jumped ship in 2010 to focus full time on real estate investing. And cool. As you know, I teach this across Canada as well. So
right.
That's my
great.
story in a nutshell.
Yeah. So I wanted to kind of ask you about CMHC because as a realtor, I mean, when I started out, I was dealing with a lot of like regular homeowners, residential purchases. Yeah. And from my understanding, CMHC, like you said, it's so just so for people who don't know, it's the Canada Mortgage and Housing Corporation,
Correct.
and they are a mortgage insurer, one of three, from my understanding, in Canada for residential purchases.
And who's the other one?
Yeah,
Forget the third one.
I
Certainly
forget the
in the
third one
morning.
too, but no, I don't know anyone who uses it. But anyways, yeah. So basically, if somebody's purchasing a home with less than 20% down, then it has to be an insured loan. It's mandatory to get mortgage insurance, and CMHC provides that to the consumer. But in addition to that, CMHC also does commercial loans, from my understanding. So they'll, if you buy like a 20-unit apartment building, you can get a mortgage through CMHC. Is that right?
Correct, and that's what I did. So you're so far you're on the money, but I just want to specify. You said CMHC does commercial mortgages, commercial residential. So it is apartment buildings. They do commercial, a small portion of it. If it's tied to a commercial residential portion. For example, we often see that in cities. You've got some, at the bottom of an apartment building, you'll have a restaurant, you'll have a dry cleaner or some businesses, and above you have apartments. So they will insure the whole building differently. Mind you, the underwriting guidelines are different. They'll underwrite the full thing. That's the only, but it's a small portion. That's the only exception when they'll underwrite purely commercial. Generally speaking, it's commercial residential, meaning apartment buildings, George.
Okay, I understand. Okay. So you got your experience with CMHC in multiple different ways. You mentioned that you were helping establish the insurance in Gaza and in the Middle East, and then you went on to become an underwriter for 4 years.
Yeah.
So after seeing people's numbers and seeing how much their maybe properties have increased in value and whatnot, you decided, why am I not doing this? Why am I just underwriting? Why not go for it full time? So can you tell us about that journey?
Exactly, George. You got it. I mean, that's why I'm in this business, George. There's a lot of money to be made. I'm not one of those that's going to lie to people and say this is easy. Making the switch, because I'm assuming a lot of your audience are if they're investors, they invest in smaller rental properties, 1 to 4 units. The cutoff is 1 to 4 rental units. Anything above that, 5 up, is called, what I said earlier, commercial residential. But when you make that move from 1 to 4 units to the bigger stuff, commercial residential, it's a brave new world. It's a much tighter world, a much more finite world. The margin for error is pretty much non-existent. I don't mean to scare the crap out of people, especially this morning. It's early. I finished my cappuccino already, but it's a lot of work. You got to do a lot of work to do what I do. But when you know it, the first deal is always the hardest. But the rules are very much different. The good news, however, so it's more work to do what I do upfront, right? You got to raise more capital. You got to have the sufficient personal net worth to qualify and all that. If you want, we can get into that. But the good news is once you move to my world, there's a multiplier effect, a wealth multiplier effect. You can make more money because small rental properties, the way we value them is the income, not the income, but the sales comparison approach, right? You look at the comps, comparable properties that had recently sold in the marketplace, and you kind of make price adjustments. And by the way, at CMHC, when I was working the default management and real estate department, it's 2 components: default management of apartment buildings, and as I said, apartment buildings rarely default to this day, my friend. So a great asset to have. And the other component of that department was the real estate. When CMHC would take some properties back from, borrowers who had defaulted. So I was doing a lot of CMAs, comparative market analysis. I had to sign off on these new valuations as my staff was trying to sell them. Well, so the sales comparison approach when it comes to apartment buildings is not the main valuation approach, the way we arrive at a value. It's really the cap rate or income capitalization approach. And bottom line, George, it's early for everybody, even where you are in Ontario, but for apartment buildings of 5 or more units, the driver of value is the income stream, your net operating income, NOI. I always tell my students, NOI is your best friend, always, right? Your job as an apartment building investor and owner is to maximize the NOI, thereby maximizing the value of the property. So that's sort of, that's the way it works. But the beauty is for every dollar, get this, George, every dollar in increased NOI that you can create, like when you increase your rent, so you reduce your operating expenses, the property will appreciate somewhere at, like say in GTA with cap rates ridiculously low. For every dollar in increased NOI, net operating income, the property will appreciate by about $20.
Mm-hmm.
So if you give a $25 rent increase, it doesn't take much time to have a much larger valuation. So you make more money, with apartment buildings. And I saw that with my own eyes. I said, my goodness, I want to do that. I want to buy apartment buildings.
Mm-hmm.
I want to invest in apartment buildings. So, and I can go on. I can tell you, I just did a vlog post. People can go to my website, Multifamily Investing Canada, earlier this week. Because at the beginning of the pandemic, I was helping out people with whatever measures that were provided by the government to face the pandemic and all of that. And I haven't been active online for the over the summer because I'm busy having fun and camping and hiking and you name it. I wanted to recap what's happened to the multifamily world. And I can tell you, even in times of crisis like now, or back in 2009 during the Great Recession, apartment buildings continue to be an amazing and sound asset. People need food and shelter. So before they start defaulting on their rent, they'll always pay. And your risks are more diluted when you invest in an apartment building. So, but a great asset to hold for sure. Yeah. And I saw people make so much money. I said, I want to do that too. So.
Mm-hmm. Yeah, definitely a great asset to hold. I think some of the arguments that people will make sometimes with regards to investing in apartment buildings, let's say, 15 plus units or whatnot, it's that if you only invest in that, you can't really rely on the cash flow to replace your income. That's some of the arguments that I hear. Would you agree with that? Or is there a way maybe that you've structured your cash flow so that you can pay yourself out a little bit and kind of replace your income?
George, if you had asked me at the beginning of my career, and so there's many layers to my answer. At the beginning of my career, when I started investing, it was at a time when Alberta was on fire, because we need to specify my portfolio is in Edmonton, Alberta. Back then, George, you wouldn't believe the legislation, landlord-tenant legislation in Alberta is very non-restrictive. There's no cap by how much you can increase your rents. It's whatever the market can bear. And we had a huge influx of immigration, job creation, all the items that make a good real estate market were all there and red hot, okay? Like kind of what you're experiencing in Southern Ontario, that really red hot. So at that time, my friend, we could increase our rents over and over. We had amazing cash flows. I know that I did the calculation at some point. So that would be in the years, I'm going to say between 2003 and 2008, rents increased by about 44% in that time span, my friend. Wow. Right? So at that time, you had tremendous cash flow. Cost of money was reasonable. I mean, it wasn't as low as it is now. Like interest rates were in the range of 6-7%, if I recall correctly. So now it depends where you invest, but there's 3 profit centers, like any kind of real estate asset, not just apartment buildings, right? And the order will vary depending what's going on in the marketplace. So you've got capital appreciation, how you make money with real estate. Obviously, principal pay down, which now these days with the low cost of money, low interest rates, is probably your number 1 profit center is principal pay down. With interest rates now, you can get, I've got one that I'm refinancing now, a loan amount of just under $1.9 million. I'm going to get a rate of 1.7%. Wow. It's ridiculous. If you look at the amortization schedule, in 5 years' time, my principal will have come down by $400,000. Okay. Wow. And then thirdly, the third profit center is the cash flow. So I appreciate what you're doing, and you're doing your audience a favor by telling them that it's not cash flow where you make the most money. But here's the thing, my friend. Maybe I shouldn't be saying this to you, but I'm gonna do it. I'm refinancing this building that I have now, which is in great condition, no capital expenditures required. Guess how much money I'm pulling out of that baby? $250,000.
Okay.
So, okay, cash flow during the last 5 years was not that great. Actually, we even have to do a little bit of capital injection because my friends out east in Ontario, Quebec, east of Alberta, east of Alberta, you need to know our economy here is not doing great. We're suffering tremendously in Alberta. Okay. But how would you like, let's say you take a 5-year loan term, which is an average loan term that most people go with. How would you like every 5 years to get a large influx of money like that? And you have several buildings. Is that okay? You didn't have a lot of cash flow during the last 5 years, but all of a sudden you end up with $250,000 every 5 years. And let's say you have 1 or 2 buildings like that, would that make your lifestyle much better? So that's how you got to look at it. But
right.
It's not like, cash flow is not, it's over time. We could get into strategies, how you make money. I don't have to pull money. There's a reason why I do this strategically, but I don't have to do an equity takeout. I could just renew and continue to pay that mortgage down, right? So it's over time. But the good news, George, if you ask me why I made the move to become self-employed and leave CMHC, because I saw those are the kind of strategies that savvy multifamily investors use, and they make a lot of money. I saw people make so much money, even like I said, in times of crisis like now, and especially in 2009 during the Great Recession. Why? Because if you recall, this is when the interest rates went down significantly, and people, even if they had a penalty to pay, would refinance, pulling millions and millions of dollars out of their apartment buildings, George. And the good news is if you do a good job maintaining the asset in good condition, like this particular building, literally my roof is done. That's why I'm doing the equity takeout. We can get into the rules changes that have occurred even during the pandemic for apartment buildings, but I'm using that money mostly to do complete improvements to the asset, right? But I don't have a lot of improvements to do, like maybe my windows, because the rest, I've owned that building for 10 years. It's been taken care of. Over the years, I re-injected capital. Like the cash flow that I had, I re-injected it into the asset itself to improve its condition. That way your cash on cash return on investment remains strong, right? It remains great. So that's one of the strategies.
Sure.
You got to be careful with me because I'm a teacher and a speaker. So if you don't stop me, I'll keep talking, right?
Right.
So.
I never stop anyone. I let you go till you feel like you're ready. So just to recap, the question was, are apartment buildings a good way to kind of replace your income? You're saying that
it takes time.
It takes time. Maybe every 5 years, you're going to refinance it, take the money out, and then you're going to have an injection of cash flow there if you want to look at it that way. Is there a way in your experience or from your perspective to, instead of refinancing, just kind of set aside some money from the cash flow every month? Or do you think that's just not a good strategy for apartment buildings?
Love your question, my friend. I really, really love your question. This is at the core. These are things. So when I teach this stuff, let me see if I can grab it quickly here. I don't have the right one here. I should have that when I do an interview. Hang on here, probably. So one has, when you make the move, you decide to make the move to invest in apartment building. Like I said, it's a less forgiving world. Okay. There's less lenders to work with you. There's less stakeholders. So you got to be very careful. But one thing that you need to know, and you need to decide for yourself, it's not a coach like me or an instructor that can decide that for you. What are your goals? So like you said, is your goal to get to replace your income? Okay, if that's the case, then you need to structure the asset at the beginning, the investment at the beginning accordingly. What do I mean by that? Well, if you want a greater cash flow, then you got to put a greater down payment, right? So that you borrow less money and you end up with a greater cash flow. That's your goal. But what's going to happen? This is not the best way to make money. Your cash on cash return on investment is going to be significantly less. So those are the kind of questions at the beginning. And for some reason, like I said, it's early, George. I don't have my flow chart somewhere. Yeah, because I have an amazing flow chart that I devised, which shows the entire process of how to invest in apartment buildings. And those are some of the questions that you need to answer. Okay. So if cash flow is your thing, then, you got to put more money down in order to borrow less money and have a greater cash flow at the end of the year. Okay. But you have to have a positive cash flow. We all know that you don't want to touch a property, an asset, and invest in it if it doesn't generate a positive cash flow. But it is, in terms of the 3 profit centers, so what I said is appreciation, capital, principal pay down, it's the third and least amount of profit is in the cash flow. But you recover that every 5 years once, you take equity out. So that's what I would say. So it is possible, but really it's over time. So what I would urge people is, if you want to get into the multifamily business and you want the asset to replace your work income, start young. I'm encouraging my kids to get into real estate at a younger age, because I wish I had figured this out at a much younger age. But like I said, I'm going to pull $250,000 out in the next few weeks with that building. And I have several buildings, and you do that once or twice. I have you so many years. Pretty nice lifestyle.
Yeah, of course. Of course. You get to go hiking on Saturdays and enjoy life.
Exactly. So does that answer the question, George?
Yes.
That's sort of, but people have to be realistic. It's not like you're going to swim in money overnight. It's more work. The expectations are so that you're going to be more professional. I don't want to belittle anybody that invests in small rental properties, but if you screw up with, let's say, a guy like you, your client screws you up and you don't want to work with him anymore, or you didn't behave very professionally with BMO, the corner bank, when you got your financing, you can always find another George, another bank that's going to work with you, right? In my world, you need to demonstrate a high level of professionalism in the way you behave with banks, because they're going to shut you out in no time. It's a finite world. And I don't mean to scare people. Anybody can do this. You don't have to be a former CMHC underwriter to invest in apartment buildings, but you got to roll up your sleeves. You got to do your homework to a much more significant extent than when you invest in small rental properties. There's no doubt about it.
Definitely. Okay. And in terms of your property management, once and someone like you, who's in a position where they have multiple units, are you do you have your own company? Have you created your own property management company, or do you just outsource that?
Oh, absolutely, George. I would say that I'm very opinionated, so I hope you don't mind that. I'll tell it, but I tell it the way it is, and I know what I'm talking about. So, I would never not have a professional property manager in place. Like you said, we're going to finish this interview with you. I'm not in a rush to finish it. Don't mind me, but I'm going to have breakfast, and my wife, we're going to head out to the mountains. I want a life. I invest in real estate to create a life for myself and my family, and create a legacy for my shareholders, right? Because like I said, what I described now, what I'm doing with one particular property right now, refinancing it, pulling that money out, there's no end to that cycle. As long as, the property's in good condition, then you can keep doing this. So it's for the lifestyle. I don't want to, this weekend, these property managers work really hard. Maybe they need to show, if I've got vacant units, they have to show the vacancies and all that. I don't want to have to handle all that crap. I want to go out hiking today, right?
Sorry, just to clarify, I was asking, if you've created your own property management company where you've hired your staff.
It's professional property management. What I'm saying is, I don't recommend people self-manage their apartment buildings. I think that'd be a mistake. Because a professional property manager has all the systems in place to collect rent and to produce quality professional operating statements. And by the way, at year end, you always have to provide your financial statements to the bank. So I cannot see myself having to do all of that work. So I pay a fee, roughly about 4% of the income, to a property manager to do that stuff. So I don't self-manage, and I don't recommend, anybody self-manages. Because when you crunch the numbers, in the operating expenses are included, among other things, your property taxes, your insurance, and all that. But you've got an expense item in your operating expenses, one for a professional property manager and a on-site manager. So these are the people that handle the hassles of being a landlord. So the property has to generate enough income to cover all the operating expenses, including, like I said, the on-site manager and the professional property manager and your property taxes and all that, and of course your mortgage. So why would you want to self-manage? If the asset cannot generate enough money to cover these, the cost of a professional property manager, you shouldn't touch it probably.
Yeah. I guess the reason that I'm asking, because I've seen certain people where they get to a point where they have so many units and they were outsourcing it, but then they decide, let me just hire a property manager, pay them a salary, and then have them manage it that way. But I understand your perspective.
Well, it's, and I've seen the other way. I've seen people where they had enough units. They tried to create their own property management company, believe you me, didn't last long. It's a tough job. It's a tough job to deal with tenants. You know that. So I would not recommend that.
Right.
Yeah.
Okay. Maybe one more question I had before we move on to the next section. What would be some of the major differences in the expenses, the acquisition expenses of a commercial apartment building, commercial residential versus like a regular residential purchase?
Like the upfront cost is what you're asking me?
Yeah. So the acquisition fees in terms of the phase one environmental and whatever else.
Exactly. Yeah.
Yeah.
So there's that. There's legal costs. So you pay for your own lawyer, legal costs, and that of the lender. In my world, let's say for a 20-unit building can be easily, it's already $14,000, $15,000. Like you pay for your legal fees and your bank's legal fees. You've got an ESA, which is a phase one ESA, which is a non-intrusive sort of investigation, whether there can be a site contamination. So that'll run you $2,500 or $3,000 easily. You should have a property assessment, a property condition assessment report. There's another $2,500 easily. You'll have, if you go CMHC insured, you'll have a premium to pay, but the important thing for people to understand, so it's a mortgage default insurance, which is like any kind of insurance, you got to pay a premium. The good news is it's not extra money you got to come up with. It's capitalized onto the loan amount. So the lender will simply add the loan amount, corresponding amount as the premium. Yeah. Okay. You've got a CMHC fee as well.
Sorry to interrupt, but for that CMHC premium, there's HST on it. Does that HST have to be paid on the closing date?
There's no HST. Don't pay HST.
No?
Don't pay tax on it.
Not on the premium. There is on the residential side, but I guess not on the commercial side.
And it's risk based, right? It depends on how much financing you're getting. So I'm just looking at some of the guidelines here, and I summarize all these things for my students. But if you borrow, you're at 85% loan to value, then the premium will be 4.5% of the loan amount. And if you borrow less, let's say up to 80% loan to value, premium is going to be 3.5% of the loan amount, and so on. So the more you borrow, the higher the risk, and the higher the premium.
So I would assume that 85% loan to value is the highest for CMHC.
Correct.
Yeah,
correct.
And that's not normal. Like you wouldn't normally see somebody go up that high with the loan to value on a commercial, would you?
Oh, absolutely. You could. It all depends where the market is at. If you're in a descending market, George, and you know value keeps going up, you don't mind borrowing. I mean, again, it's not your money. It's the bank's money, right?
Yeah.
So your cash on cash return, if you borrow less and you're in a great red hot market, you know, the property appreciates and now the cost of money is so low that you pay the principal down very fast. Why not?
Yeah.
Every circumstance, every market is different. And what phase of the market are you in currently when you acquire the asset or refinance the asset? So it depends. But note, is it prudent? Now that's a different question. I can tell you for myself, especially in an Alberta, in a market like Alberta that's suffering right now, it calls for prudence, for caution. My average is probably about below 70% loan to value of my portfolio, because I like to have that nice cash flow as well and not be, you know, strangled by financing costs, right? So but again, these are things that you need to figure out in your head. Right? What's your risk, your tolerance for risks, and so on. So that's sort of where we're coming from. Those are questions you got to answer for yourself.
Sure. Okay. So just to go back to the differences in the cost. So you said the legal fees. We talked about the ESA,
the lawyers, the banks.
Yeah.
ESA.
Property assessment report.
Yeah.
And then
the CMHC application. If you go CMHC, it's going to be $150 per unit. And then the same thing with conventional financing. The lender will charge you a fee for doing the work. So usually 1% is what, if you go to a mortgage broker, they'll charge you 1% to do the deal for you. Right.
Yes. And there's an appraisal fee as well.
Not so good question. Let's now draw the distinction between two types of financing that are available to people. So we talked about CMHC, and you did a good job of recapping what CMHC does, mortgage default insurance. So that's called CMHC insured financing, right? Because CMHC, the bank gives you the money, the loan, and CMHC insures the loan, the bank's loan, against borrowers defaulting. So that's CMHC insured financing. If it's not CMHC insured financing, it's considered conventional financing, all right? So conventional financing is different. There's many variations. You cannot, the longest, the highest loan to value, first of all, is 75% loan to value, whereas CMHC, we just saw that the highest loan to value is 85%. The longest amortization period that you can go with a conventional loan is also 25 years, whereas CMHC, you can go up to 40 years if it's a new building. Mm-hmm. So those are things that make a huge difference on the bottom line, right? Yes. If you go conventional financing, again, non-CMHC insured financing, George, you need an appraisal. They need to have the valuation confirmed by a third-party appraiser. Whereas if you go CMHC insured financing, they don't formally require you to have an appraisal. So I would, because quite frankly, they don't give a crap about market value at CMHC. Can I just say that very bluntly? Okay. That's something that stumps a lot of novice investors. They think they're going to get market value. No, CMHC insures the loan, not just for the loan term, let's say 5 years, 10 years, whatever loan term you choose, but it's for the full period of the amortization. Mm-hmm. All right. Which means what? It kills the renewal risk at loan maturity. What do I mean by that? And especially in the time right now, I tell you, when the pandemic started, a lot of people that had non-CMHC insured loans were freaking out because some of the lenders, depending which market you were in and their perception of the risk caused by the pandemic, conventional lenders at loan maturity, let's say you take a 5-year loan term, have no freaking obligation to renew the loan with you if they don't like market conditions at that time. Whereas CMHC, no, a loan renewal, the loan was insured for the full period of amortization, 25 years or up to 40 years, like I said. They have the obligation to renew. And believe you me, I'm speaking from experience. Yes. I had a lender that was refusing. Well, they said value had come down. And at low maturity, they said, well, we're giving you two choices. Either you pay the principal down by a couple $100,000 because the value is less than what we had on the book 5 years ago when we financed the loan, or you pay us out the full outstanding loan amount. I said, take a hike. I used to work for CMHC. Do you think I don't know the rules? They try to pull a fast one on me. Right. So that's a significant advantage when you. So
what'd you do? What'd you do in that situation?
I said, I literally said, not in those terms, but pretty much I said, excuse me. I said, take a hike in the sense that I said, no, I paid my premium. The loan is insured for the full period of amortization, and my loan is current. I've never missed a payment. Mm-hmm. It's in great condition. You just renew, and they did. Okay.
Well, it's a good thing you knew the rules.
You got to know the rules. I teach the rules. People can come into my workshop and learn the rules because, you got to learn the rules. Yeah. Like I said, it's a different world.
That's great. Okay. Okay. So those are so we covered kind of the difference between a CMHC insured loan versus a conventional commercial residential loan. We're talking specifically. Yeah. So I think that was pretty much the major differences. There might be some other minor. Did we miss anything there in terms of expenses?
You don't pay a premium, obviously, when you go conventional. But like I said, even when you get conventional financing, but like I said, I would say people that don't know the business very well, I have in mind a lot of older folks that say, oh no, I don't want to go CMHC insured financing because I got to pay a premium, right? Whatever percentage of the loan amount based on their loan amount. But like I said, it's not extra cash. That premium is simply added to the loan amount and capitalized and amortized with the rest of the loan. Right. Let me put it to you this way. A lot of people, and I argue, right? I hang out with mortgage brokers. I talk to them. A lot of them are my friends, or they come to my multifamily investing workshops and all that. They argue, why go CMHC? But make no mistake, going with CMHC is clearly more beneficial. I'm sold, not because it's my former employer, but because you pay an interest rate of about 1% lower. Okay, so the CMHC protects the banks against borrowers defaulting on their loans. So the way that lenders pass on that advantage to us borrowers is by reducing the interest rate by 1% roughly, right? You got to shop around for interest rates. But the point is that when you go CMHC insured, it's a pain in the butt to, let me show you what it looks like because I got it right here. This is the kind of work, like this is, and it should be even thicker. This is my financing application, the one that I'm waiting to hear back. Well, we're fiddling around the loan amount right now, but I know I'm going to get my loan amount because I know how the game is played, right? Being a former insider. But this is a lot of work. You got to cross a lot of T's. They ask a lot of questions. So it's a pain in the butt, but I'm going to get an interest rate, like I said, for a loan amount of $1.9 million of 1.7, 1.8%.
Wow. Yeah.
Whereas if I went conventional financing, i.e. non-CMHC insured, it's going to be 1% higher than that. So 2.7 or 2.8%.
Right, right.
So that means you more money and a greater cash flow, George. And also because you can extend the amortization longer than a conventional loan, which is limited at 25-year amortization, you get a greater cash flow, right? And you don't have to spend that money, George. Like I said, you can use it, reuse that cash to improve the asset or sit on it. And to be honest with you, these days, what I'm experiencing in Alberta, I'm sitting on the money. The money's accumulating in a bank account because these are tough times. So, so longer amortization when you go CMHC and greater loan to value, possibly up to 85% loan to value. But CMHC rarely will base the loan to value on market value. That's the other caveat or warning I want to give people. Usually CMHC's landing value, the value that they'll use to calculate the loan to value, is usually lower than market value, which is why they don't want an appraisal, because they don't want to be bound by market value. So.
Right. Yeah, I've heard of that too. So let's say your place is worth $2 million, but CMHC is saying that we're going to value it at 1.7. Yeah, and you're saying it's still beneficial, even though you're leaving some money on the table.
Yeah, and it's cautious. CMHC works on behalf of all Canadians, but don't take it from Pierre-Paul. What do you think the large institutional real estate investors, multifamily investors do? They go CMHC all day long, like the real estate investment trust, all day long, George. They go CMHC insured financing for the reasons I just mentioned. Right. Greater flexibility, but it's a lot of work. I'm not going to dispute that.
Yes.
And turnaround time is terrible. Right now, I submitted this application in July, and I still don't have a loan approved. Right. Whereas conventional financing, super fast, matter of weeks.
Right. Okay. That's interesting. Yeah. So there's the two good options, but they each have their advantage, and it's just a matter of picking which one works best for you.
And these are things you need to figure out. And, as you probably know, this is the kind of stuff I teach when I teach. I teach with case studies so that people can play with these concepts.
Yes.
Right? But at the end of the day, as an investor, what are your priorities? What are your investing goals? You need to figure that out. What is, based on those priorities and goals, what is the best strategy for you?
Right.
And if you have shareholders like I do, you got to factor their desires as well in there, right?
That's right. Okay, perfect. Okay, so let's jump into the next section. Is there anything you want to add before we do that?
I don't think so. That kind of gives you a pretty good idea of the differences and financing and all of that. Yeah, it's
Perfect. Okay. I appreciate that. So let's go into the random 5. So I'm going to ask you 5 random questions, and you are just going to tell me the first thing that comes to mind. The first question is, who's your go-to band or artist when you can't decide on something to listen to?
Oh, you know what? I'm going to give you a cheesy answer. I spent time in Brazil when I was a kid, a year, and I like that bossa nova jazz stuff.
Okay, cool.
Yeah, very much so.
All right, perfect. What was the most historic thing you witnessed in person or took part in?
Historic. Boy, that's a toughie now. I need another cup of cappuccino, George.
Yeah.
Historic. Well, I studied law. I've got a law degree in political science at U of T and all of that. Well, I will say, okay, I'll stick to real estate area. Sorry, I got to think this through. Wow, it's early in the morning to answer kind of questions like that. But, 2008 and 2009, the Great Recession, and especially I was still at CMHC back then. The fall of 2008, and even the summer of 2008. Let me go back to that, because you see, I'm a formerly an Eastern like you. I grew up in Quebec, but went to school in Ontario. When I was back east in Ontario or Quebec, the price of the barrel of oil didn't matter to me, right? Now it does, big time. And in the summer of 2008, a barrel of oil in Canada, Western Canadian Select, was sold for $140 a barrel. Do you know how much it sells for now? It sells now for about $30, 35, or maybe 40 now, I think. I stopped because it's so depressing. I stopped monitoring the price of barrel of oil. But the reason I said that, it went down during that summer, the fall of 2008. And I was buying my first apartment building on my own. And this is when credit stopped around the world. I don't know if you remember that. Banks didn't lend. And I had a loan approved with one of my lenders, and the lender didn't know whether he'd have money to give me for my financing. That was pretty historic event happening. It was a scary time, my friend.
Yes, I can
Very,
imagine.
very, very, very scary time. That's history in the making. Price of oil being that high, which now started crashing, and then the drop in interest rate.
Yes.
Yeah, I since then I follow macroeconomics and the price of gold and what's going on around the world. I've just even this week been reading about China. So anyway, that was a very historical event that I witnessed, and I think we are in the middle of history right now. But
yeah, I was just going to say, I know we're in the random five here, but just out of curiosity, what are your thoughts on where the market's headed?
like the real estate market, or generally?
Yeah, just in general, real estate, the economy.
Okay. Yeah. Well, I can talk about that stuff. Like I have an increasing passion for macroeconomics.
Yeah.
So I studied at UT, got a degree in political science. So even what's going on in Canada, I'm following very closely. I got to stop because it's driving me nuts. And I won't go there because I could go on a political rant. You have like no idea.
Okay.
But Canada is not in good shape by any means. I'll say this much, and I'll leave it at that. We're not very well managed in this country. A lot of division. But I would say we are witnessing the decline of the American empire, truly. With all this quantitative easing, that's taking place. And now even in Canada, China is becoming the world leader. And I was just reading something yesterday, and this is stuff where I try to stretch my mind. The US has some 1 trillion in bonds, securities outstanding there. And do you know how much China owns of that 7.1 trillion? 1 point something trillion. So a good chunk of it. And, there's stuff going on with China right now, like a trade war and all of that. Tensions are really high between the US and China. And China, if they decided to sell their US bonds, it would destroy the world economy, would destroy the American dollar, because and they're deliberate. It's a country I know well. I studied even Mandarin when I was in my days at U of T. I've been to the country a few times. It's a country that's fascinated me. I studied the history. So we are witnessing the decline of the American empire. And they've got an accumulation of gold. So this kind of stuff is very fascinating. It's not conspiracy theories or anything. It's very real. And of course, we don't know all the truth, what's going on behind the Chinese wall, right? To use that analogy. So we are witnessing history in the making. And of course, we know where the pandemic came from. And these are historical times. And it's very strange for me because of my, I'm well-traveled and I speak a bunch of languages and I travel regularly. Well, not since the pandemic, obviously, but until then. And I have the sense, and I read a lot, what's going on historically. We are living through historical times, major impact. And the pandemic will leave us with, we'll be different people. We can see the changes occurring right before our eyes. The way my kids are going to university right now, online and all of that, and businesses. So this is also a major historical event we're witnessing.
Yes, definitely. Okay, perfect.
Long-winded answer. Sorry, but you're talking to a professional speaker, so I'm sorry, somebody that reads a lot. So
no problem. I appreciate your answer. Number 3, what do you think the next big technological advance will be?
Wow, these are tough questions, George. You want us to answer them spontaneously?
Yes.
So because I'm in an oil and gas province, I do monitor what's going on with energy transitions and all of that. People need to understand, this is something I read, and I may even do a kind of a TED Talk video about this, because I think people are very well ill-informed. I don't think it's electrical cars. I don't think it's windmills by any means. All of these still require a lot of oil to produce, by the way, and they're not recyclable. So I don't think that's, Tesla and all of that. And if you start peeling the onions, you see that a lot of these people that are trying to shift away from gas are still needing oil to produce whatever technology. Wow, George, this is a tough next technological advance. It's definitely our energy source has to be what it is. It's like I said, I don't think that at this point in time that solar is it yet, but but we have to find, I don't know the answer to that, George. I think it's a technical question, but it has to be something having to do with sources of energy, because we can't go on the way we are going.
Mm-hmm.
We are destroying our planet. Like as much as I don't think that we can walk away from oil and gas overnight. I mean, we cannot. Scientifically, it's impossible. But it has to be a different source of energy that we need to use that is cleaner and good for the environment.
Yeah.
Whatever that may be, but it is not solar. I urge people to go and watch Planet of the Humans, a documentary by Michael Moore. I urge you to watch this, Planet of the Humans by Michael Moore, and Gibbs is the producer. It'll be an eye-opener. You'll see that we're not, So
okay.
I don't have the specific technology.
Yeah. No, that's fine.
More cleaner source of energy for sure to save our world.
Yeah, I'm catching you off guard here, but you're coming.
And I only had one cappuccino.
Yeah. All right. Number 4, when was the last time you immediately regretted something you said?
Gee, I'm French Canadian. I'm mouthy all the time.
Yeah.
Telling my wife her hair looks funny.
Yeah.
Oh no, you don't do that. She always looks good. Oh my gosh, George, these are tough. I will say this much, regretting saying something all the time, George. I put my foot in my mouth all the time. I ask my kids. My kids say, "Dad, put your filter on."
Yeah.
I don't
so
have
it's a regular occurrence for you.
It's saying stuff like that, saying too much what I think without thinking twice.
Yeah. Well, that's okay.
But I'd rather be like this than a hypocrite. I think we live in a hypocritical world. I don't like that. What you see is what you get. And I'm genuine. I speak from the heart.
Fair enough.
So.
Fair enough. Okay. And the last question here is, what success principle do you live by?
Always be open-minded. Always be open-minded. I read voraciously. So I went to law school. So when law school, you read like judgments from judges, like sometimes very thick. I read all the time. I read audiobooks. I go to the bathroom. I read while I'm in the bathroom. I shouldn't tell you this, but I do, and I read fast. Now with iPhone, you can read everywhere. I'm cooking. I have an audiobook going on. Open-minded is success. The world is evolving. There are opportunities out there all the time, and I want to be on the lookout. I wish I had that kind of mindset earlier in life, but believe you me, I instilled that in my kids. I'm very proud of my kids. I have 3 children. My youngest is 15. Obviously, he's a teenager, typical teenager, but then I have a 20-year-old daughter who's in 3rd year university in sciences, going hopefully into med school, and a 22-year-old also in sciences, and I'm very proud of them. They're well-traveled. They already also speak 3 languages, which I'm so proud. Never thought my kids would also be multilingual like I am. And they're open-minded and open to opportunities in the world. So being open-minded. We are in a time of crisis, but every period of crisis brings with it a lot of opportunity. So being open-minded, I think, is key to success.
Definitely. That's great. Okay, perfect. Well, I appreciate all of your you sharing all of your knowledge, and I just wanted to ask you to finish things off. How do people reach you, and what services do you offer?
Yeah, so multifamilyinvestingcanada.com, multifamilyinvestingcanada.com. The kind of services I offer. I do have an online business. I have an online course that I'm going to be giving. I just decided on the date of the next virtual workshop, because obviously we can't gather. It looks like we're in the beginning of the second wave of COVID-19. Next workshop is going to be at the end of October. I believe it's October 30th. Let me just look at the date here. October 30th, 31st, and the 1st of November. It's a 2.5-day workshop, all virtual now, but it's live. I answer your questions. Just look me up. At multifamilyinvestingcanada.com. That's what I do. Unlike other people, as you know, even given this interview, I am an action taker. I am an active investor. So I do this a couple of times a year. That's how I help people create wealth for themselves. It's my mission, George, by the way, to democratize the access to multifamily investing in Canada. A lot of people out there don't want me to teach this stuff, right? The insiders' tricks and strategies and all that. But I make it if I can help somebody create wealth for themselves and their family, my hope is that they'll do good in the world with the wealth that they create for themselves. That's my mission.
Perfect. That's great. Yeah. So I'll be sure to include your information in the show notes. And in October, the next one's coming up. And yeah, I think that's it. Any final messages for the audience?
take care of yourselves, folks. Yeah, I do. It was in my vlog post on Monday that I published. These are difficult times. Make sure you find the time to appreciate what you got. So early, I don't have my gratitude rock, which I carry with me every day. But make time to have joy and happiness in your life, because this pandemic is tough on everybody. It's tough on the kids as well. Their social structure is destroyed. They can't go out as much with their friends. So take care of yourselves, you folks out there.
Awesome. That's great advice. Okay. Well, I appreciate your time today, Pierre-Paul. And I look forward to sharing this with people. I think there's a lot of good stuff in here. So I hope you'll enjoy the hiking that you're going to do today with your family. And I look forward to talking again soon.
Thank you. Thank you, George, for having me. Take care. Cheers.
Thanks once again for listening to another episode of the Well Off Podcast. Just want to remind you that if you do appreciate the content, all I ask is that you comment, maybe like it if you can on the platform that you're listening to it on, and finally share it with friends and family. I'd love to get the message out there, and it would mean a lot if you can share it. And finally, I just wanted to offer you, as a valued listener, a free copy to the Roadmap to Real Estate Investing, which is a document that I've put together which helps you identify what strategy would best suit your needs at this current time. You go over certain things that are included in this document step by step, and it'll hopefully provide you with some clarity. So have a look. You can go to www.welloff.ca/guide to download your free copy.